4. Panicking when the market is down. Stocks are generally more attractive when no one else wants to buy them, not when barbers are giving stock tips. It's very tempting to look for validation, or other people doing the same thing, when you're investing, but history has shown repeatedly that assets are cheap when everyone else is avoiding them. In the words of Sir John Templeton, one of the first investors to systematically scour foreign markets for bargains, the time of maximum pessimism is the best time to buy. The most famous example of this is a Business Week cover story from the 1979 that asked the question, "The death of equities," not long before the start of an 18-year bull market in stocks. More recently, Barron's featured Warren Buffett on its cover in late 1999, asking, "What's wrong, Warren?" and bemoaning Buffett's aversion to technology stocks. Over the next 3 years, the Nasdaq tanked more than 60%, and Berkshire Hathaway shares appreciated 40%. We also see empirical, rather than anecdotal, evidence of this in a study that Morningstar has conducted every year for the past several years, in which we look at the performance of unpopular funds. After looking at which fund categories attracted the most money and which categories experienced the strongest outflows, we found something very interesting. The asset classes that everyone hated outperformed the ones that everyone loved in all but one rolling 3-year period over the past dozen years. The difference can be striking. For example, investors who went where others feared to tread and bought the 3 least popular fund categories at the beginning of 2000 would have had roughly flat investment returns over the subsequent 3 years. That was much better than the market's average annual loss of about 15% over the same time period and miles ahead of the performance of the popular fund categories, which declined an average of 26% per year during the 3-year period. Going against the grain takes courage, but that courage pays off. You'll do better as an investor if you think for yourself and seek out bargains in parts of the market that everyone else has forsaken, rather than buying the flavor of the month in the financial press. 5. Trying to time the market. Market timing is one of the all-time great myths of investing. There is no strategy that consistently tells you when to be in the market and when to be out of it, and anyone who says otherwise usually has a market timing service to sell you. Consider an interesting study in the February 2001 issue of Financial Analyst's Journal, which looked at the difference between buy and hold and market timing strategies from 1926 through 1999 using a very elegant method. The authors essentially mapped all of the possible market timing variations between 1926 and 1999 with different switching frequencies. They assumed that for any given month, an investor could be either in T-bills or in stocks and then calculated the returns that would have resulted from all of the possible combinations of those switches. For the curious, there are 4,096 possible combinations between 2 assets over 12 months. Then they compared the results of a buy and hold strategy with all of the possible market timing strategies to see what percentage of the timing combinations produced a return greater than simply buying and holding. The answer? About 1/3 of the possible monthly market timing combinations beat the buy and hold strategy. You may be thinking, I have a 33% chance of beating the market if I try to time it. I'll take those odds. But before you run out and subscribe to some timing service, consider 3 issues. 1. The results in the paper cited previously overstate the benefits of timing. Because they looked at each year as a discrete period, which means they ignore the benefits of compounding, as long as you assume that the market will generally rise over long periods of time, that is. 2. Stock market returns are highly skewed, that is, the bulk of the returns, positive and negative, from any given year comes from relatively few days in that year. This means that the risk of not being in the market is high for anyone looking to build wealth over a long period of time. 3. Not a single one of the thousands of funds Morningstar has tracked over the past 2 decades has been able to consistently time the market. Sure, some funds have made the occasional great call, but none have posted any kind of superior track record by jumping frequently in and out of the market based on the signals generated by a quantitative model. That's pretty powerful evidence that market timing is not a viable strategy, because running a mutual fund is a very profitable business. If someone had figured out a way to reliably time the market, you can bet your life they'd have started a fund to do so. 6. Ignoring valuation. This one came back to haunt many people over the past few years. Although it's certainly possible that another investor will pay you 50 times earnings down the road for the company you just bought for 30 times earnings, that's a very risky bet to make. Sure, you could have made a ton of money in CMGI or Yahoo during the internet bubble, but only if you had gotten out in time. Can you honestly say to yourself that you would have? The only reason you should ever buy a stock is that you think the business is worth more than it's selling for, not because you think a greater fool will pay more for the shares a few months down the road. We'll talk a lot more about the concept of intrinsic value and valuation more in another video. For now, just remember that the best way to mitigate your investing risk is to pay careful attention to valuation. If the market's expectations are low, there's a much greater chance that the company you purchase will exceed them. Buying a stock on the expectation of positive news flow or strong relative strength is asking for trouble. 7. Relying on earnings for the whole story. At the end of the day, cash flow is what matters, not earnings. For a host of reasons, accounting-based earnings per share can be made to say just about whatever a company's management wants them to, but cash flow is much harder to fiddle with. The statement of cash flows can yield a ton of insight into the true health of a business, and you can spot a lot of blow-ups before they happen by simply watching the trend of operating cash flow relative to earnings. One hint: if operating cash flows stagnate or shrink even as earnings grow, it's likely that something is rotten. We'll talk more about the importance of analyzing cash flow in a new video, and I'll show you how to use it to detect potential accounting problems. If you can avoid these common mistakes, you'll be miles ahead of the average investor. Now, let's move from what you shouldn't do to what you should do. In the next video, I'll show you how to separate great companies from average ones.